Take the discussion forward with Vikas Khemani joining us on the show today. Vikas, good morning. Markets not doing a whole lot, seem to be stuck in a narrow range, but I observe that you've been doing a lot of interesting things, including long range cycling, huh? Getting a lot of time off from markets or what?
That you have to keep doing all the time. So you have to take time off from market for sure for your work. You have to balance. So yeah.
Vikas, it's been 18 months of consolidation. When was the last time we saw this kind of a long consolidation in the market? Do you remember?
I think Ajay, these kind of things do come after a very sort of sharp rally in the markets. We saw 21 was a great start. I mean 20 itself late 20 did very well. 21 was a great start. And also we have to keep in mind that what happened last year, post Ukraine war. I mean it has happened like once in a 40, 50 year kind of history where this kind of sharpest tightening has happened, and implication of that if you see globally in the markets is negative. uh, Fortunately for us, we are just consolidating, right? So you always have an operating environment, and within which you operate, and returns always come from that. And given where the environment is, of course, I think India has done well. India has held out very well. Of course, we have not had positive returns, but at the same time we have not had negative returns. So I think we are in a good consolidation phase. We are still, I think, probably in a phase of time correction, because there are no obvious immediate catalyst and there are some potential risk around. So I think, till then, market would probably, move around in a narrow range, and that can probably continue for some more time.
Right. Vikas, when we just look at the markets, how things are happening globally, the SVB bank issue came in and now you have a buyer for that bank. Similar was the case with Credit Suisse as well. Can you just tell us that how these global news are being absorbed, or the impact of this global news is also reducing?
See, look, global financial markets have, I mean, whenever you do this kind of sharpest tightening, there's always going to be repercussions somewhere, because markets and the system is integrated system, and one does not know which part of the system will get impacted, and there will be, because when you do this kind of sharpest tightening, there is bound to be mark to market losses, there bound to be asset pricing, because that is intended to kind of slow down the demand, intended to impact the asset pricing, and which is what has kind of happened. And now, which form it sort of comes out, nobody knows, and still it is not over. So we do not know what kind of impact would be there. Only thing is that comforting part is that the regulators and the governments have around the world has come around and say we will make sure that no big institution fall, and thereby no cascading impact of that is there. But having said that, somebody has to bear that pain, and so I would assume that right now that trickiest environment is there. The moment inflation peaks out, which I personally believe is around the corner, because you already seen food price, commodity price, energy price correcting. As the inflation number prints lower, or in a comforting range, you start seeing interest rates sort of settling down, and thereby environment overall settling down. But as far as India is concerned, our interlinkages in the global economy, as far as the capital dependency is concerned, are very less, and we don't depend much on that. You cannot remain completely unimpacted in an integrated global economy, but our dependency or impact is far, far lower than it has ever been, and India is reasonably well placed. And to that extent, we haven't seen any major impact on our currency. We have not seen any major impact on our markets. So that clearly shows the resilience of Indian economy and Indian markets. And I see when again things settle down, Indian markets will outperform.
In the wake of the global volatility and the time correction that you pointed out, a lot of sell-side brokerage analysts are pointing out that Indian markets have become reasonable when it comes to valuation. So that premium, that huge premium that India was commanding, seems to have ebbed away. But what are you doing with your incremental flows at this point of time? Would you say that it's better to keep the powder dry and wait for more correction, or you have started nibbling into the market and putting it incrementally in select stocks?
Frankly speaking, we've been telling our clients that this is the time to deploy capital. When we get money, we don't sit on cash, because I mean nobody can time the market, but we fundamentally don't see a major downside from here unless save and accept some major unexpected catastrophic event happens. We see markets in the fair value zone. We see India growth continue to remain intact, and whenever this kind of fearful environments are there, lack of interest kind of environment are there, they are typically, forming a base for a good run ahead. Now, whether that will happen in 3 months' time, 6 months' time, we do not know, and nobody can predict for that matter. But this like gives very reasonably good comfort that, if you take 12 months, 18 months, 24 months out, definitely there is money to be made, and risk reward are definitely in favor. Now, with that, can markets go another 5% down? Very well, and nobody can predict for that. But I think risk rewards are definitely falling into place as far as the Indian markets are concerned.
Some specific areas of the market. I see that Aditya Birla Capital is a name which interests you. I don't want a reaction on the stock, but there's a development brewing over there, and that is they're selling off one of the insurance arms to Samara Capital. And we have seen a leadership change as well. Does it appear that this is a part of an overall larger strategy of hiving off non-core, bring back focus back, because they couldn't really scale this business up over the last 10-year plus. You must have studied the business model in detail. How does this news actually look to you?
You said you don't want a stock specific comment.
No, I don't want a stock specific comment on the stock, but the evolving business model.
No, so definitely, we own the stock, so I don't mind we own the stock with a full disclaimer that we like the stock, and I think that we typically look for companies where a good business model, and whenever there is a change of leadership happens, and we believe that leadership can put the growth trajectory back on track. Like you said, in the past, company has not gone anywhere, and we do believe that the new leadership is capable of putting this platform into the new orbit. And that's where I think you see today institutional ownership almost negligible or no. Institutional ownership valuations are far more lower than most of the competitors and players. So that is where risk reward is there, and we think if 2-3 years out, if you look at 25 to 30% kind of growth is possible. So that's the thing, and whatever transaction you saw is a part of the ongoing strategy of consolidating and focusing on their core areas, and selling of non-core business. And that I think every leader does when somebody kind of gives the organization a new direction based on the strategy. So I see this event as one more in that direction.
Vikas, what are you doing incrementally with your IT positions? You have exposure to HCL Tech, LTI, Mindtree, Infosys, etc. Are you adding on to them, trimming your positions?
No, we are just holding on to that, and right now neither we're trimming nor we are adding. We're just holding on to that, and there would be time. Now I don't know whether it is 6 months, 12 months down the line, when US environment settles down, when US talk about interest rate starts coming down happens. In my opinion, that would be the time to add IT in a big way. So we will be looking for an appropriate moment and time to add our position. But right now we are just holding on.
Talking of adding positions, Nisha, do you know that HCL Tech, which of course is in the portfolio of Vikas, is where promoters also consistently adding positions. So that's the only large cap IT stocks I've observed where promoters are consistently, every quarter they're adding position, despite of what's happening in the environment. So that's something to watch as a long-term observer of that particular stock.
So Vikas, let's continue with that discussion. About 18 months back, you liked banks. But after that, IT has really made a top and corrected quite a bit. So have a few banking names. And always in the market, you've been in the market for long. So it's always been IT versus bank. What would you want to buy now? What is your top favorite name now?
It's never IT versus bank. It is always, you play what is, what you think has a growth profile. And right now, like you said, we are significantly overweight in banking sector because we think the credit growth has just started and we have a long legs to grow. So at least next 18 to 24 months, banking sector looks pretty decent. So we continue to do that. IT, like I said, that we were earlier significantly overweight, we became equal weight, and some point in time we might look to become overweight. That we keep evaluating, but right now, we have a positive view on both. We like banking more. We think that if market is going to rally from here, banking sector is the one which will take lead. Large part of the heavy lifting will have to be done by banking and industrials.
In banks, are you sticking with ICICI Bank as your top bet or expanding the view a tad bit there?
We have ICICI Bank as our top bet. We've been holding that position for the last 3 years or 3.5, 4 years, and I think we continue to do that.
Because, when we talk about ICICI Bank, it's of course, into a different league now. When you talk about banking sector, you can also include PSUs, you can include NBFCs within that. Any of the other names or other, smaller sectors within banking that you like, microfinance, if you don't want to give names, any of the smaller banking names also that you like?
Not really. We are not very big fan of smaller banks because I think the business game has shifted really in favor of large financial services, well, large players, be it NBFC or banks, because raising liability side is equally very important, and also investment in technology very important. Both of them remain the domain of or sort of edge is there in favor of large players. So we typically stay away from microfinance, small finance banks, or smaller banks for that matter, either large banks or large NBFCs is what our preference.
Right. What do you make of fee-based companies, the likes of life insurance, AMC business, where capital requirement is less and fee-based earnings are high? Are you a fan of that? And a lot of changes happening this morning from IRDA. Earlier, we saw some changes into mutual funds as well.
So I think, of course, you like every business you monitor. There's no question on that. Because non-credit financial services also a very large, emerging, growing area. Within that, there are different players. AMC, like that has been going through different challenges for last few years. Continues to remain so. So we still think that there are more challenges right now, especially for the larger AMCs. Insurance business again is going to go through a significant change. We are expecting unified license coming through, tax changes which has happened. So there are certain headwinds which are there. So we right now don't own anything, but we keep evaluating, and we will get some point in time when the risk reward is in the favor. Yeah, but I mean, you constantly keep looking for these franchises because they are very all credible franchises and high ROEs. The only thing right now is the growth part is something you have to take care. Stocks typically do well when only growth comes, and I think right now in most of these franchises, I think growth is becoming a little bit of a challenge, and given whatever changes are happening, so we will look for a moment when we get a lot more comfort around the growth, and that's where we'll get it.
Vikas, I would urge you to stay with us. We'll just come back to you in a minute. There's a breaking news which is happening, especially in the sector, in the insurance sector, which you were talking about. There are commission changes which IRDA has actually conducted, and Anurag Shah, my colleague, is here to talk more about changes and specifically which part of the insurance sector is positively impacted by that. Anurag, fill us in.
So expenses of management rules has been notified by the government, and these will be effective from 1st of April 2023. Presently, expenses of management, there's a separate limit for expenses of management which include management expenses plus commission expenses. So separate limits are there for health insurance, motor insurance. But now onward, there will be no segment limit on commission for life insurance, general insurance, and health insurance. There will be a single expenses of management limit, and it is a good news for private insurance companies like Star Health, ICICI Lombard, because now onward they will be able to spend more on commission, rewards, and advertising. They will be able to spend more, and in a way it's a negative for PSU insurer like New India Assurance, because their overall fixed expenses, salary expenses, and management expenses are too much, so they will be they will not have that much window to spend on commission. Apart from that, this is a big positive for OEMs and aggregators like PB Fintech also, because now they will have a big bargaining power with the companies. Whosoever companies will be giving them more commission, they will be able to tie up with these companies after the rules. So one more clarification is required in these rules, because in IRDA draft notification, expenses of management limit for general insurance companies was mentioned at 30%, and standalone health insurance companies were mentioned at 35%. So final, what limit has been decided, there's a clarity required in this, but single limit EOM has been finalized in a notification issued, and it will be effective from 1st April 2023.
Okay, Anurag, thanks very much for bringing that to us. PB Fintech in particular, which Anurag was also talking about, is gaining in trade on the back of those changes. Thank you very much for joining us, Anurag. Vikas, a last question to you on a Pune-based, almost forgotten, engineering group. But the way this group stocks have come back, I'm talking about the entire Kirloskar pack. You have Pneumatic, But even Kirloskar Oil Engines saw very high interest in a block which just happened. Then Kirloskar Ferris is doing very well in trade right now and good. Have you studied anything beyond pneumatic as well within that, the business models of the group? Even the holding company is doing so well. So there seem to be a lot of interest in all these Kirloskar brothers stocks.
Ajay, I would probably actually avoid doing stock specific comment.
Okay,
there
sure.
seems to be a lot happening, but I would avoid that.
Okay, so let's talk about these mid-cap engineering names in particular, because the Siemens ABB variety are often called expensive, and they don't correct a whole lot also, even in market disruption times. But there's this pocket of mid-cap engineering kind of names. Does it interest you beyond what you also own? You're researching more ideas there?
Absolutely. I think see, India is in a massive capex cycle, and that capex cycle is going to last over next at least 4 to 5 years. And when this kind of capex cycle happens, most of the engineering companies do well. And today, order book of most large and mid companies is reasonably well placed. So any such correction, as long as you have to, of course, study the business model, mode, management, everything else, but as long as you understand that part, you believe that we like that space a lot, and we constantly keep on evaluating companies in that space where we think that, and in this space, I can say that many companies that today who are small and small companies or mid-cap companies, they will become fairly large because that's a very promising space at least over the next 3, 4, 5 years.
Thanks so much for that, Vikas. Always good to get perspective from you. Banks is the favored name now, and stick with the large ones where there is a lot of earnings visibility is the key takeaway. Let's now go